What is the S&P 500? If you've ever watched the news or scrolled through finance headlines, you've probably heard the term S&P 500 being tossed around. But what exactly is it and why does it matter so much? Let's break it down in simple terms. The S&P 500 is basically a stock market index. Think of it like a giant scoreboard that tracks how 500 of the biggest publicly traded companies in the United States of America are doing. These companies include giants you've definitely heard of, like Apple, Microsoft, Amazon, Google, Tesla, and many more. Together, they represent a huge slice of the US economy. The S&P stands for Standard and Poor's, which is the financial company that created the index back in 1957. The 500 simply refers to the number of companies that have been included. But here's the key. The S&P 500 isn't just a random list of companies. It's carefully designed to reflect the performance of the US stock market holistically. That's why people call it a benchmark. It gives us a quick snapshot of how the economy is doing overall. Now, here's how it works. Each company in the S&P 500 has a different size or market capitalization, basically the total value of all its shares combined. Bigger companies like Apple or Microsoft have more weight in the index, meaning their stock movements influence the S&P 500 much more than smaller companies on the list. So, if Apple stock shoots up, that has a bigger impact on the index than if a smaller company stock rises or falls. So why is the S&P 500 so important? Well, it's considered one of the best indicators of how the US economy is performing. If the S&P 500 is going up, it usually means that most of these major companies are doing well and investors feel confident. On the other hand, if it's going down, it can be a sign that businesses are struggling or that investors are nervous about the future. Another reason is it matters is that if it's often used as a benchmark for investments. Many mutual funds and ETFs, those are exchange traded funds, are designed to track the S&P 500. That means when you invest in one of these funds, you're essentially buying a tiny slice of all 500 companies at once. It's a simple way for regular investors to spread out their money and lower risk instead of betting everything on one single stock. Here's the cool part. Historically, the S&P 500 has delivered strong long-term returns. Sure, it goes up and down in the short term, sometimes by a lot, but over decades, over a long period of time, it's grown significantly. That's why financial experts often recommend investing in funds that follow the S&P 500. So if you want to build wealth steadily over time, S&P 500 might be something to look into. To sum it up, the S&P 500 is more than just a number on the news. It's a powerful tool that shows us how the largest companies in America are performing. It guides investors and it helps shape the way we understand the health of the economy. Do let us know if you have invested in the S&P 500 and what you think about that in the comment section below. Don't forget to like, share, subscribe. Catch you in the next one.